Momentum and price divergence. In this video, we'll discuss the role of momentum and price divergences in identifying price trends. The ball example used at the beginning of the chapter showed that maximum velocity was obtained fairly close to the point at which the ball leaves the hand. Similarly, prices in financial markets usually reach their maximum level of momentum ahead of the final peak in prices. If the price makes a new high, which is confirmed by the momentum index, no indication of technical weakness arises. On the other hand, if momentum fails to confirm, for example here at point B, notice that price movement upwards do not agree with the momentum downwards. So there is a divergence which is set up, a negative divergence is set up between the two series, that is price and momentum, and a warning of weakening technical structure is given. Such discrepancies normally indicate that the price will undergo a corrective phase, a corrective process. It can take the form of either sideways movement like a horizontal trading range, or more likely a downward movement, as we can see here, a downward movement. However, the price will sometimes continue upward to another top and be accompanied by even greater weakness in the momentum index. For example, at point, as we can see, the divergence further increases at point C. Occasionally, the third peak in the momentum index may be higher than the second but lower than the first. Either circumstance requires some degree of caution, since the characteristic is a distinct warning of a sharp reversal in price or long corrective phase, as we can see here. Also, we can see here a positive divergence where momentum and price are moving towards each other. So we can see price falling, and this is the momentum, price going here. So there is a brief period of positive divergence, both of them moving together. So this is a brief period of positive divergence, as we can see, which indicates strengthening of prices, and prices actually show upward movement after that. So here we can observe the positive divergence. In this instance, the price makes it low at point E, but this was preceded by the oscillator. So oscillator was also showing an upward increase here, and before that there was a downward movement. Oscillator in fact bottomed at point D, after which it was rising. So there was sort of positive divergence set between prices and oscillator, as we can see here. Now please note, it is extremely important to note that divergences only warn of a weakening or strengthening market condition and do not represent actual buy or sell signals. Whenever any divergence between momentum and price occurs, it is essential to wait for some confirmation from the price itself that the trend has been reversed. For example, here, notice there is a upward price movement, but the momentum oscillator does not agree here. So oscillator is going down, which indicates a negative divergence, and some kind of trend reversal may happen, which is further confirmed by this trend line break here. So there is a confirmatory evidence, and after which indeed prices fall and trend is reversed. For such confirmations, as we discussed earlier, we can achieve that by looking at the violation of simple trend line, as we saw here, some kind of violation of trend line, or the crossover of moving average MA, the completion of price pattern, as we can see here in the figure. As a general rule, the greater the number of negative divergences, the weaker the underlying structure. At point C here in the figure, as we can see here, the prices moves to a new significant high here, but the momentum indicator is barely able to remain the above equilibrium line. So it is barely at equilibrium line. Such a situation demands utmost caution when accompanied by a trend line break. As we can also see here, the trend line break is there, which is usually a sign of extreme technical weakness and is often, though, but may not be always, but often followed by a sharp decline, as we can see here. Same situation can occur in a bear market and should be viewed as a very positive characteristic, especially if the upward trend break in the price is accompanied by a high volume. The more explosive the volume, the more likely or reliable the signal is. For example, here we can see virtually no downside momentum in the final low. So when there is a final low, it does not have much momentum, and then it shows some kind of upward movement. Momentum shows upward sign, which leads the upward price momentum. So before prices start moving up, there is a momentum which shows some kind of mega overbought. This is sort of mega overbought, which is the first thrust in the bull phase, and we can see there is a sharp rally in prices. Another confirmation is the violation of this trend line. So number of signals are available to us. This is like extreme bullish divergence, which is as compared to this was extreme bearish divergence. This is more of a bullish divergence. Another interesting example here in the chart, we can see the Nikkei index movement, and we can see the violation of a 3.5 year trend line. So there's a violation of 3.5 year, almost 3.5 year trend line here, which gets violated here. The trend line violation occurs. And we can also examine the movement of ROC. ROC is going downside, so there is some kind of negative divergence being set up. 30-week ROC is plotted, which is crossing, almost crossed here the equilibrium line. Anyway, it was falling earlier. So there's a negative, strong negative divergence with the index. As a result, the final rally was accompanied by very little in the way of upside momentum. It would have been a mistake to sell on any of the prior divergences, but a very timely sell signal was generated by waiting for confirmation in the form of trend line break, as we said earlier, in the index itself. And also there is a 65-week MA which is plotted. So the EMA chart is also there, which is for also crossed over. So another signal is from EMA crossover. This, notice this dotted line which is 65-week EMA. So along with trend line, that EMA is also crossed over. A divergence that set up very close to equilibrium line is often followed by a sharp price move when confirmed by price. So we can see here the divergence is set up. ROC, the 13-week ROC is closer to equilibrium line, which shows a lot of weakness. And then price, all this is confirmed by actual price action here. With respect to complex divergences, it is always a good idea, and it is always widely recognized that price movements are simultaneously influenced by several cyclical phenomena. Because a single momentum indicator can monitor only one of these cycles, it is always a good idea to compare several different momentum indicators based on different time spans. One approach is to plot two momentum indicators of different time spans on the same chart, as we can see in the figure here. Since this method tries to monitor two separate cycles, it is wise to choose two different time periods. For example, not much can be gained from a comparison of 12 and 13-week ROC, since they would be very close to each other. So in contrast, for example, as we can see here, 13 and 26-week spans would clearly differentiate and reflect different cycles. Most of the time, the two indicators are moving in gear. As we can see, most of the time, these two indicators, 13-week and 26-week indicators, are moving in gear. So this study does not give us much information. On the other hand, when the long-term indicator reaches a new peak and short-term is close to the equilibrium line, that is, long-term indicator reaches its new peak and short-term is close to its equilibrium line or below it, they are clearly in disagreement and out of gear. For example, at A2 in the figure, they are clearly in disagreement and out of gear. This normally but not necessarily indicates that a reversal in the trend may take place, and usually an important one. And this is further confirmed by here trend line violation. And also we can see the long-term EMA. There is a long-term dotted EMA plot, 40 weeks EMA plot, which is crossed over by the index. So there are number of evidence, violation of trend line, EMA crossover, and then there is a negative divergence that was set up between long-term and short-term ROC. So this is normally but not necessarily indicates a trend reversal may take place, a very important one. Even so, it is very important to make sure that such divergence is confirmed by reversal in the price itself, as we can see here. These are often referred to as complex divergences, and they occur in a positive combination also. As we can see here in point B1 in the figure, we can see here some kind of complex divergence is set up. As we can see here, a short positive divergence. The short term is moving above while the long term is still moving down. So a sort of positive divergence is set up, which indicates some kind of positive trend, expected positive trend or strengthening of the price, as we can see here, which is further confirmed by the trend line violation. So this positive divergence is confirmed by the trend line violation, and also the EMA is crossed over towards upside. But the ultimate confirmation should be taken from the price action, which reverses to the upside. So a number of signals here confirming that the price trend reversal has taken place on the upside. To summarize this video, we examined momentum and price divergences and how they can be employed to understand the price trends and trend reversals. We also noted that in order to capture different time influences of different cycles or influences that have different time periods or cyclical in nature, we can employ momentum oscillators of different horizons, for example 13-week and 26-week horizon ROCs. And often they provide us with complex divergences like negative and positive divergences. Negative divergences indicate some kind of reversal on the downside, while positive divergences indicate strengthening of price and expected movement towards the upside. In this video, we'll discuss momentum trend reversal techniques. Basic concepts such as trend line, moving average crossovers, price patterns can be applied to momentum indicators as well. Occasionally, it is possible to construct a trend line on the momentum indicator by connecting a series of peaks or troughs. An example for an uptrend reversal is shown here in the figure. Notice in this figure, when this trend line is violated, a trend reversal signal for the oscillator is generated. So this is the trend line with the momentum indicator, this is the trend line with the price. So here the signal is generated, which is slightly leading as compared to the actual price signal. So this is a bearish momentum trend break because it predicts some kind of downward movement. Also, the cross at AA indicates that bearish movement, which is sort of confirmation, and a leading indicator is the momentum trend line violation on the downside, and it is confirmed by the price action as well. This type of momentum weakness must be regarded as an alert, and action should be taken only when confirmed by the price trend itself, as indicated at point AA in the figure. In effect, the momentum trend break is reinforcing the price trend break, and it offers an additional piece of evidence that the trend has reversed. These momentum indicators can also be smoothed by incorporating moving averages. Here we have already seen the example of uptrend reversal. The warning of trend reversal in the price should be offered by a reversal in the smooth momentum index itself, or penetration of a moving average by a designated overbought or oversold levels. For example, here we have signaling a new uptrend is featured in the figure. It is possible for momentum trend break to precede that of a price by some time, as we can see here. So the momentum trend break is on the upside. Price trend break is also on the upside, but is slightly lagging the momentum trend break, as we can see here. And then there is an overbought signal, possibly a mega overbought. It is possible for the momentum trend break to precede that of price by some time, yet it does not generally lose its potency because of this. As a general rule, it does appear that if both lines are violated more or less simultaneously, or if the price trend is violated first, strength of the signal is enhanced. It should also be noted that momentum trend line break, like as we can see here, the momentum trend line breaks can be confirmed by any legitimate trend reversal technique in the price, be it a moving average crossover, price pattern, peak and trough progression, reversal, etc. Often it is useful, the momentum changes, they are often useful in predicting prices in terms of directional changes. So smooth momentum index like the one shown here, notice that it leads the price movement. So whenever there is advance in momentum, it leads or indicates that in future the price may go up. So it indicates some kind of up momentum in leading manner. Often this can be further improved by adding overbought and oversold levels. For example, here we have overbought and oversold levels. Whenever there is a crossover, recrossovers with smooth momentum index, so this momentum index is smooth by some moving average measure, and whenever there is a crossover, it indicates some kind of signal generation in a more leading manner before the price itself moves. So it gives us leading signals before there's a change in price direction of price movement. However, this should only be considered as one evidence in the overall weight of evidence approach. The final action or confirmation should be taken from the actual price movement itself. Please note that momentum indicators are also capable of tracing price patterns because of the shorter lead times normally associated with reversal of falling momentum. A breakout from accumulation pattern, when accompanied by a reversal in the downward trend of the price itself, is usually a highly reliable indication that a worthwhile move has begun. It is important to use a little common sense in interpreting the momentum price patterns. For example, have a look at the figure here. It shows a breakout from a reverse head and shoulder. So there is a reverse head and shoulder in the momentum. In the momentum index, it's a reverse head and shoulder pattern that takes place from an overbought condition. So there is an overbought condition from where the head and shoulder pattern appears. This is not to say that such signals will never be valid, but it stands to reason that a breakout from an extreme level is very unlikely to result in a sustainable price move. Remember, technical analysis deals with probabilities, and the odds of a favorable outcome in this case are low. If you want a tip of this type of failure typically develops in a contra trend way as a false upward breakout, in a primary bear market or a false downside move in a primary bull market. So we can see here this breakout is not sustained. As soon as it breaks out, then again it falls and then falls further and further. So there a bear market run starts. This also indicates here some kind of neckline, or you can say reverse head and shoulder in price also. Some kind of neckline or trend line violation happens. Price moves to the downside. Here you can see the momentum is providing some sort of leading signals. It breaks and then goes down. Since the break was already coming from such a high position, chances were high that it will be on this direction rather than going up. It will be on this direction. Already there was a sustained bull market phase, so chances were of falling prices were more, and therefore we expected this reverse and shoulders not go up but to go down. By now it is apparent that all the trend determining techniques used for price are also applicable to momentum. Interpretation of momentum indicators, as described earlier, depends to a considerable extent on judgment. One method of reducing this subjectivity is to smooth the ROC index by using an MA. Warnings of a probable trend reversal in price being monitored or offered by momentum moving average crossovers as indicated in the figure here. For example, have a look at this momentum index momentum and its moving average. So the smooth one is moving average and the fluctuating one is the momentum itself. Notice that there are a number of whipsaw signals. However, instead of using the momentum itself, if you use a short-term MA of momentum and a long-term MA, those whipsaw signals are eliminated and signals are more solid. For example, here you can see a downward breakout by the short-term MA crossing down the long-term MA, and this signal is further confirmed by the price action here on the downside. Similarly, here there is an upside breakout which is also confirmed by the price moving up, and again the downside breakout which is further confirmed by the price going down. So the whipsaw signals are less here as compared to here where we are actually using momentum and its MA. So momentum, because momentum is much more fluctuating, it gives us a lot of whipsaw signals here. In the earlier approach, using this approach, just using momentum, not a smooth version of it, the problems is there are a number of problems with this approach. Is that the momentum indicator is very jagged like this whipsaw signals, then the price index that it is trying to measure, causing the generation of an acceptable number of whipsaw signals that we saw. Now we can filter out some of these whipsaws by using a combination of one short term and one long term MAs, as we saw in the analysis and figure here. And buy and sell alerts are given when the short term MA crosses above or below, like here crosses from above to below or below to above the long term counterpart. As we can see, the price also went down and went up, confirm the actual momentum signal generated, which is confirmed by the price action itself. To summarize, in this video we discussed that momentum indicator itself can be used in a similar manner with other evidence like we did price, for example trend line violations or application of multiple moving averages. For example, we discussed that like price where we use short term moving average and long term moving average. With momentum also we can apply the same approach by using moving averages with momentum and generate signals. Momentum generally offers leading signals because it moves in advance as compared to the time, as compared to the actual price action itself. In this video, we'll discuss relative strength indicator, that is RSI. The computation of RSI is very simple with this formula. RSI equal to 100 minus 100 upon 1 plus RS, where RS is the average of X days up close prices divided by the average of X days down prices. One can also compute difference or return form for RS. Here X is the number of days, for example 28 days or 30 days, 45 days, whatever suitable period for the analysis, which is justified by the price movements. The indicator has several advantages. For example, the erratic price movements are smooth because of the averaging. These movements would have affected the ROC computation. Also, it ranges from 0 to 100. So this measure offers a constant band of 0 to 100 within which the RSI indicator would fluctuate. In this fashion, RI becomes extremely useful for making comparison between different securities on the same chart. For example, if you have the 100 and 0 levels constant for both the securities, and both the securities will fluctuate in between, and we can establish universal standards of overbought and oversold. For example, 70-30 or 80-20 overbought and oversold levels, as we discussed in the previous videos about overbought and oversold levels. Extreme values here, for example, if the overbought and oversold levels are too extreme, like 90, 10, these values would mean less violations because these are extreme moves. So these values would mean less violations, but if there is a violation, the signal would be very strong. Also, the choice of these overbought and oversold levels and violation would be determined by the time span as well. For example, if the time span is too short, like a few days or something, then it may cause wider RSI oscillations, while as compared to that, larger time span would cause narrower swings, and the breakout points can be adjusted for depending upon the time span, whether it is larger or smaller. When we can adjust the overbought and oversold level or breakpoints. Anytime RSI is above its overbought or below its oversold level, overbought or oversold, if it is above or if it is below the oversold level, it means the current trend is about to reverse. There is a high chance and the security in question is ripe for a turn. Whether it is, if it is going up, it may go down, or if it is here, it may go up. The significance of this turn depend upon the time. What is your time horizon? For short time horizon span RSI, the moves may be more frequent, while for a long term RSI, the moves may be less frequent and their significance may be more. Consider this diagram here where we have 70-30 bands and RSI is fluctuating here. Now these are consistent swings above overbought level, indicating that some kind of movement may happen. These are like failure swings. The momentum tries to cross the overbought level. This is a 14-day RSI. For example, points A and point B offer good alerts that now the security in question may fall, and such divergences are set up. For example, here the price is still moving up while at this time the momentum is going down, and it has witnessed a failure swing as well at B, and it is going down. So this kind of negative divergence is set up between momentum price, and there's a high probability that price may fall down. We can also use RSI in conjunction with trend line violations and price pattern completions. For example, here we can see that some trend line has been violated on the downside, which indicates a high probability of reversal. Again, there is some failure swing happening here at the oversold level. The momentum has tried to cross the oversold level once. Again there is a failure swing, and therefore on some kind of divergence is set up. This is sort of positive divergence, and we can expect the momentum to rise up, which is a leading indicator that price may also rise up. So the rising price, and it is also crossing the trend line from below to above. So there are a number of confirmatory signals. First, the leading signal is given by the momentum. After this failure swing, chances are momentum, because it was hovering around at the oversold levels, it may reverse, and it actually is confirmed by the price action itself, which crosses the trend line on the way up. So there is a strong upside move. To summarize, in this video, we discussed the construction of relative strength indicator, that is RSI measure. We also saw how to apply it as a momentum indicator or oscillator for understanding that current trend and probability of its reversal. In this video, we'll discuss trend deviation or price oscillator indicator. The construction of this measure or trend deviation or price oscillator measure is simple. You have on numerator a certain period MA divided by a longer duration MA. For example, it can be 1/10 price oscillator, which is 1 day MA divided by 10 day MA. In this figure, we have the price of Brooklyn Bancorp and its 15-day MA. This is the 50-day MA within two bands, plus 10% and minus 10%. Two bands are created and price fluctuates within these bands. On the bottom panel, we have the same data but expressed in the form of price oscillator format. Notice that this is 1/50 format, 1 day MA divided by 50-day MA, and top 10% plus minus 10% bands around it. The interpretation of trend deviation indicator is very similar and based on the same principle as we have been discussing. This method can be used to identify divergences, as we did earlier, overbought and oversold levels, and it appears to come into its own when it is used in conjunction with trend line construction. For example, notice here that the oscillator indicator witnesses some kind of weakness here. It touches the overbought level and this comes down, which indicates some kind of weakness in momentum, which is confirmed by the price action itself, which is on the top of the band of the upper 10% band and then starts moving down. It crosses the MA level from top to bottom. This is another confirmation that down move is there. If you look at further at this place, there is some kind of price pattern formation, like reverse head and shoulder or trend line violation, neckline or trend line you can call it. The violation occurs from up to bottom to above. In the momentum indicator or price trend oscillator itself, you notice that there is also some kind of violation of reverse head and shoulder pattern, trend line or neckline violation, and then momentum moves up, which is further confirmed by the price here. So price also moves from the lower part of the band towards the upper part. So there's up movement in the price. So this way this is confirmed. Basically momentum or trend deviation or price oscillator is giving us some leading signals, which when confirmed by moving average crossovers, trend line violations, is further confirmed by the price action itself. To summarize, in this video we discussed the construction of trend deviation and or price oscillator, stochastic indicator or %K, %D indicator. In this video we'll discuss the role of stochastic indicator in predicting price trends. Theory suggests that prices tend to close near and upper end of the trading range during an uptrend. That means if there is prices moving up, if there's an uptrend, then prices tend to close to the upper end of the range. As the trend matures, the tendency for prices to close away from the high and close near to the end of the session, low of the end of session, becomes more pronounced. In a downward moving market, the reverse conditions hold true. That means when the downward move or bearish phase is in strength, prices will tend to close on the lower side, while when it is maturing, then prices will start to close on the higher side or upper side. The stochastic indicator attempts to measure the points in a rising trend at which the closing prices tend to cluster around the lows for the period in question and vice versa, since these are the conditions that signal trend reversals. And this is plotted as two lines, %K line, %D line. %D line is the one that provides the major signals and therefore more important. Let us see how it works. So the formula is simple. %K is formula is 100 into C minus Ln upon Hn minus Ln, where C is the most recent close and Ln and Hn are the lowest and highest of the low and high price for the last n traded periods, and can be 5 days or 9 days or so on, depending upon the analysis. Now %D is some kind of moving average of %K. It can be 3-day moving average, 3-period moving average, or 5-period moving average of %K. Since D is the moving average, %K line is more quicker, more faster in absorbing the information, while D is more slower because it is the moving average of %K. So this results in a momentum indicator with two lines, %K and %D, fluctuating between 0 and 100. So the measure is bounded between 0 and 100, and one can set up overbought and oversold levels at 75 to 85% and lower on the upside and 15% to 25% on the downside. Let's see how this works. So here we have the price on the top, 5-day %K, %D indicators for 5 periods. %D is set up and %K is also for 5 days. This is plotted here. So the signals are generated and overbought indication is given when %D line crosses the extreme band on the outer side, but actual signal is generated when a faster %K line crosses from above to below. So when %K line crosses the %D line from above to bottom, the signal is generated. This is a very similar to dual MA system, short-term and long-term MA system that we have seen earlier. This can also be modified. For example, you can set up a 10-5 system where %K value is based on 10 days and then it is smoothed by 5 days. The moving average which we use for calculation of %D line is computed for 5 days. So you can construct that system. Also, you can further slow down the stochastic by creating a 5-5-5 system. That means instead of using the %K line, you can further slow down by using %D line, which replaces the %K, and then %D is further smoothened by using some kind of MA, maybe 5-day moving average of %D. So there is another dual system. Instead of using %K, we use %D and its moving average, which is further slowed down stochastic. Now again, signal generation is same. We examine points at which the slowed down %D line crosses the overbought, and then see when the more faster %D line crosses its moving average from above to down or down to above, signal generation occurs, but the actual final confirmation comes from the price action itself. Talking about crossovers here, so normally the faster percent K line changes direction sooner than percent D line because percent D is moving average of percent K. This means that the crossover will occur before the percent D line has reversed the direction. For example, here the crossover is occurring here. So percent K line is crossing percent D line, which is slower, indicating some kind of reversal, but a more confirmatory signal comes from the slower percent D line itself when it turns direction. Now at this stage, if price is going out above, a negative divergence is set up. That means even if price is moving above, percent K line fails to confirm a new high in the price and vice versa for lows, thereby setting a negative divergence. So a if there is a negative divergence, this signals a reversal in trend, and it has a higher strength because now the percent K line is turning at overbought level. So the chances of momentum falling is much higher, and therefore prices probably have the current trend is weak, so they have less strength and chances of reversal is high. Similar thing is happening here where now crossover has occurred from down to above. It is going in this direction, and if prices are still if let's say prices are still falling, again a positive divergence has set up, which indicates that now prices may go up. To summarize, in this video we discussed percent K percent D indicator or stochastic indicator. We noticed that its construction is slightly different. It's based on the fact that when prices are the maturing or some kind of trend like bull trend is maturing, then prices have a tendency to end up at the lower points, while if a bear run is maturing, then the prices have tendency to close more at higher end of the movement. It can be employed in a similar manner as any other momentum indicator. It has advantage of slowing down the stochastic. We construct percent K and percent D line. We can further slow down by taking moving average of percent D indicator also. It acts similarly to a dual MA system. Momentum is a generic term embracing many different types of momentum measures and oscillators. Momentum measures the rate at which prices rise or fall. It gives useful indicators of latent strength or weakness in a price trend. This is because prices usually rise at their fastest pace, well ahead of their peak, and normally decline at their greatest speed before their ultimate low. Since markets generally spend more time in a rising than a falling phase, the lead characteristic of momentum indicators is normally greater during rallies than during reactions. Oscillators reflect market sentiment and have different characters in primary bull and bear markets. There are two basic methods of interpreting momentum: momentum characteristics and momentum trend reversals. Momentum signals should always be used in conjunction with a trend reversal signal by the actual price.